Hi guys, today I'm going to be talking to you about ESG investing. So what is ESG? Well, ESG stands for environmental, social, and governance issues. It's a framework that investors use to determine what they invest in, whether that's companies or funds or so forth, as well as how they vote at shareholder meetings for these funds and these companies. It's not necessarily about politics or your personal beliefs, although there are groups that advocate ESG principles like, labor unions or environmental groups. But at the end of the day, it's about creating long-term value for the companies and the funds, because oftentimes what's good for society and what's good for, the employees of the company can oftentimes be good for the shareholders of the company as well. Um, it helps minimize risk, helps maintain the reputation of the company, can open up new opportunities, and can lead to a more engaged and productive workforce. But when companies ignore these principles, oftentimes what happens is they get in trouble with regulators. Like, for example, when BP had a big oil spill back in 2010, they ended up having to pay fines. Same thing happened with Volkswagen when they were caught trying to fix the results for emissions tests on their cars. So they ended up having to pay fines as well. In other cases, their reputation can take a hit. Like, for example, Cambridge Analytica, when they used data in an unauthorized manner, and that caused other companies or other people who would have wanted to do business with them to pull out, and so they lost a bunch of money. It can also cause low return. Like, for example, with ExxonMobil, they've been their board, a good number of their board members were just voted out in a contested election because there was a hedge fund, a small ESG promoting hedge fund, that was concerned that Exxon wasn't working as quickly as many of the other oil and gas companies to transition towards a more, renewable business model. They were still sinking huge amounts of money into these oil projects that weren't really giving, big returns. But if they had cared more about, their governance and the environmental aspects of ESG, then they probably would have taken that more seriously. And so for a long time, ExxonMobil's had, relatively low returns, low profits, compared to some of the other companies. So that's what can happen when the companies brush aside ESG concerns. So what are some types of ESG investing? ESG investing is when a fund or an individual investor basically decides, okay, I'm going to put my money into funds or companies that align with certain ESG principles, and there's a variety of ways they can do that. One is so-called socially responsible investing, which doesn't necessarily overlap with ESG investing. It can involve, really the best way to think of it is as avoiding so-called sinful investments, such as tobacco, gambling, arms, alcohol, fast food, and fossil fuels. But impact investing is more focused on a certain social cause. Like, for example, green bonds are a form of impact investing because, if you're buying bonds, because companies will often give out these green bonds so that they can, raise revenue for certain projects that improve the environment, or they may be renewable energy companies, for example, like building solar panels or something like that, which will reduce, fossil use and so forth. So really, green bonds are a way of impact investing companies that have projects that will improve the environment. So let's start with the E in ESG, which is environmental issues. So there's a variety of environmental issues that investors should be aware of. Like, for example, greenhouse gas emissions and global warming is a big one. It can cause ignoring this can cause a lot of problems for a company. Like, increased climate change can cause more property damage. Like, if you're looking at much of the western U.S. is in a drought, and that can cause property damage. But also, all the fires, the wildfires are becoming, like basically yearly, um, yearly uh, disasters, as opposed to things that in the past might have happened once in a decade. And so the increased frequency of many of these disasters is causing huge amounts of property damage, and that also affects infrastructure. So if you're in the real estate industry or the telecom industry, or if you're a power provider, that can really affect you, because if you're not being more proactive about global warming, then a lot of your infrastructure will take on greater and greater hits, and you'll have to spend huge amounts of money to fix that instead of providing services for customers. Another thing that can happen is if you're in the agribusiness industry, global warming often causes lower crop yields because less and less arable land remains arable because of the increased heat. In some parts of the world, because of various climate treaties like the Paris Agreement, increased enforcement of things like Kyoto Protocol and so forth, there's more lawsuits. Like, for example, Shell recently lost a big lawsuit in the Netherlands, and they were forced to make a lot of changes to their company because they weren't really really considering how to handle climate change. And because of that, now all of a sudden they have to move really quickly to figure out some plan to keep themselves afloat, while complying with this new mandate from this Dutch court. Whereas if they had just thought about it earlier, or if their investors had put a little bit more pressure earlier on, they might have had a plan that wasn't gonna just completely tank their profits entirely, or give them a huge hit to their profits. Okay, so other things that can happen because of climate change are changes in the markets themselves. Like, for example, there's a huge shift away from fossil fuels. Part of it's because the fossil fuels are becoming more expensive on their own compared to renewables. But another part of it is because people are realizing how bad consumers are realizing how bad fossil fuels are for the environment. So they're trying to shift away from that. Also, some governments realize that too, providing subsidies for things like electric vehicles, solar panels, and so forth. So that means that if you're involved in the fossil fuel industry, that's a big market risk for you, because all of a sudden you're swamped with a bunch of angry customers who don't really want to use fossil fuel products, and you also have angry governments to deal with that want to incentivize people to move away from that. So if you just ignore all of that, ignore the ESG principles as a company or as an investor, or so forth, then what's going to happen is you're going to sink a lot of money into something that seems profitable right now, but the long term may not be as profitable. There's also changes to the markets themselves, really like human risk. Think best example of this would be like a lot of Pacific Islands, right? They're barely above sea level. As climate change gets worse and worse, so the storms are getting worse and worse. So a lot of these islands, in the next few decades, they're gonna see huge hits to their infrastructure, and some of them might even just go completely under the water. So you're talking about the elimination of, they're not huge markets, but they're still significant markets. So that's also something to consider. And then another issue is natural resource scarcity, like droughts, for example, would be the best example of this. This means there's less resources to transact business, especially in the agribusiness industry. Waste. So this can be anything plastic, or toxic sludge and so forth, acid mine drainage in the coal industry. It can cause a lot of reputational damage, because people don't really like the idea that these companies are putting out these poisonous things that can harm people, or they're putting things that harm the environment. This can lead to many lawsuits. And it can also cause indirect impacts on various areas, like if you're in the tourism industry. Like if you're, I don't know, certain, like a beverage company, and you give a lot of your, you know, plastic cans and so forth. A lot of what you're selling is going to like these tourist spots, like, along the beach or something like that. And then, but you're not really concerned about, having like recyclable plastic and so forth. Then what's going to happen is a lot of people, like, if you're just like selling all of these, non-renewable things, then it can end up harming your business because, like the tourists might just like not dispose of plastic properly, and then that tanks the tourism because fewer people want to go to places that are like full of trash everywhere. So like there are very indirect impacts that always can't be predicted. So it's important to like for these companies and investors to to be aware of all these issues. Okay, let's go to the second part of ESG, social issues. So this can be things like labor rights, wages, technology and automation, like making sure companies are keeping up with that, like how they educate their workers, like giving them skills that are still relevant in society, and helping them deal with automation, strikes and forced labor abroad are becoming big issues. Like a lot of some of the shareholder meetings, you're seeing like resolutions about forced labor, so forth, and that can also lead to like lawsuits for these companies, which harms the company as well as the shareholders. So it's important for investors and these companies to keep that in mind when they consider how they want to structure their labor. You can also see a lot of social issues around like consumer rights. Ignoring this can cause, and what I mean by consumer rights is like product safety, things like that. Oftentimes it can be really embarrassing when like a product's not safe and then it has to be recalled. It just creates like a huge media circus. So that can be bad for a lot of companies and their investors. It can lead to lawsuits, and it can also cause significant reputational damage. There's a recent like spike in a lot of resolutions related to like political lobbying, around like like how these companies give donations to certain politicians and so forth that some people don't like, or that it fosters corruption and so forth. So there's a lot of that can also cause negative like reputational damage to many companies that also has to be considered. Okay, with governance issues, this can be a variety of things like board and workplace diversity, equity, and inclusion. Increasingly, and sometimes another issue you'll see at the shareholder meetings is they're trying to get these boards to incorporate like meeting these standards for how the directors get money, incorporate that into like the standards or the calculation that determines the pay of these high-level employees. So that's a big issue, and also just like overall workplace diversity and so forth, which can be important for the company because like when these companies are like marketing to diverse audiences, it's important to have people who like who are more familiar with these various audiences, so they're able to like market better, I guess. Um, some boards we're seeing like, or some shareholder meetings you're seeing like resolutions about like qualifications of boards. Really, this mainly comes up when it's like there's a contested election, like with ExxonMobil. There's a big issue around like the fact that a lot of these directors weren't really that experienced on the board. They were just like new recruits or something like that, or they had irrelevant non-energy industry experience, and so that also became a big issue. So if like companies just like avoid those issues around like the qualification of their boards, then it can cause like contested elections, a lot of bad media scrutiny and so forth that these companies don't want. So they should try and avoid that. There's also like a lot of resolutions around like transparency, like disclosures about lobbying or climate change or CO2 emissions or human rights or various other issues. Just like a lot of shareholders want more transparency nowadays. We're also seeing a trend where a lot of these mandatory resolutions about CEO pay or executive pay, like usually at a lot of these shareholder meetings, I think it's by law or by regulation or so forth, but a lot of these companies have to put out these advisory votes on whether the shareholders approve the CEO pay, the executive pay or not. So the shareholders will vote on that. A lot of these motions are being defeated because sometimes it's just like the CEOs and executives are paid. At least to some people, they consider the pay of these executives as very high, which in their eyes contributes to like income inequality, and also like if you're spending a lot of money on compensating people, then you're taking away money from shareholders and from new projects you could be involved in that actually make money for the company. So the CEO pay and executive pay is becoming a bigger ESG issue as well. There are a variety of rating systems used to like rate companies and funds on ESG. These can include the MSCI ratings. MSCI is like a financial services company that helps people, invest in certain companies and so forth and funds. So MSCI ratings, they rate the companies based on 35 different ESG issues, and these are relative ratings. So just because a company gets a high score doesn't necessarily mean they're doing good. It just means that they're doing better than the other companies. Okay. And in addition, they're weighted by industry, size, and location. So it's not necessarily, so two companies might have the same score, but they might get different ratings. Like, for example, if a non-fossil fuel company gets the same score as, like, if a company that doesn't do business in, like, fossil fuels gets the same score as a fossil fuel company, then that's not really, even though they might be the same score, in reality, one is, like, actually doing better than the other because of the industry constraints and so forth. Size of the company and location are also considered, and it uses this scale. The scale is based on like a certain way of reporting credit scores. So if you can see right here, these are the 35 various issues that are considered, like climate change, resource use, pollution, how they handle environmental opportunities, labor, product liability, social opportunity, and corporate governance, and so forth. Okay, and then there's the Morningstar ratings. Morningstar ratings are more for funds as opposed to actual companies. So what they do is they basically give these scores for the companies that are in the various funds. So companies are rated from 0 to 100. A score of 50 is like an average score. A score of 70 is a score that is two standard deviations better than the average, and a score of 30 is 2 standard deviations below the average. And then so what they do is they grade the various companies in these funds, and then they like aggregate them based on the share that the amount of money that the fund holds in various companies and so forth. So at the end of the day, you get a 5 globes rating, which is basically like if there's 5 stars, it's like an A, 4 is like a B, or 5 globes. If 5 globes like an A, 4 like a B, 3 like a C, 2 like a D, and 1 like an F. But it's all relative, so just because you have a fund that has like a 5 out of 5 doesn't necessarily mean it's that great. It just means that it's better than the others that are similar to it. So the star ratings over here are for like overall, just how much money does, or how effective is the fund at generating returns and so forth. and the globes are for sustainability ratings. So you want to look for funds that like have good ratings on both. Like for example, this 1919 has 5 sustainability, 5 Morningstar, so that it seems on its face like a good fund to invest in, like that. But it's also very important to look for companies and funds that have high ratings in your preferred areas, as opposed to just in like overall ratings. So you might be concerned about a given issue, but if you just go off the overall score, then you might have a problem where you're investing in a company that or a fund that seems to be ESG friendly, but in reality it's not that good on the issue that you care about. It's becoming more important because a lot of funds and companies and so forth are trying to like rebrand themselves as like ESG friendly, even though they may not necessarily be. Some like funds, they might just have an ESG committee or department or whatever, but in practice they're not like given that much influence at all. It's just the same thing as was before, same equal less unsustainable practices. So it's important to look for what issues you care about. For example, this is Microsoft's rating, and on its face it looks pretty good, right? AAA, it's the highest rating. But if I am someone who really cares about corporate behavior, then this probably isn't the company for me because it has a pretty low rating on that. So it's important to look at the specific issue you care about, not just like investing in generic ESG friendly companies and funds. So what are the consequences for some companies that don't follow ESG principles? Oftentimes, various funds, governments, consumers are holding companies accountable. Many big mutual funds like BlackRock, Vanguard, and so forth, they're voting for shareholder resolutions that push for a lot of ESG issues. The thing about shareholder resolutions is that even though most of them are non-binding, in practice, when they get a majority, like 90% of the time the company implements them, because when they do get a majority, it's very rare, so that causes like huge amount of like media coverage of these events, like at least in like some financial publications and so forth. So that creates a lot of pressure, and so they ended up implementing whatever the resolution asked for, usually the vast majority of the time. And some funds are divesting away from companies that don't do well on ESG metrics, which means that it's harder for the company to have the funds it needs to do whatever projects it needs to make money. So it's important that the company and the investor keep all these things in mind, keep ESG issues in mind, so that they can avoid all these potential negative consequences. And so another important part of another way like a lot of people can get involved with ESG, or not other than just investing or picking their investments, is shareholder voting. So it's very important to vote at the annual meetings because it helps helps the companies and the funds keep the ESG principles in mind. Because like I said earlier, even though most of these proposals are non-binding, in practice the company will just usually do whatever the resolution says if it gets a majority, because of potential negative consequences that can occur if they the shareholders revolt against the company, or as it's often called in the press and so forth. So usually if you're a shareholder in a company, you get proxy materials. Usually you can like Google these materials, but oftentimes the company will mail it to you, or your broker might give it to you if you have your stocks handled by a broker. And the proxy material will have a lot of info about the candidates and the proposals that will be voted on. They'll also have the directions to vote. Let's see. Ballots are weighted by the number of shares owned. So it's one share, one vote in general. So if I own like one share, then I get one vote. or my vote counts as, my ballot counts as one vote. If I have 100 shares, then my ballot counts as 100 votes. In general, only common stock gets to vote. So if you own like preferred shares, then usually that does not, you don't get voting rights for those, but common shares do. But some companies, usually these are like tech industry companies, where oftentimes like the product that they're selling is very original, like think Facebook, Twitter, and so forth. So the founder still wants to have, like they wanted to have like a lot of control over the company even after like it's become public. So oftentimes these companies will have different classes of voting shares, different voting rights. For example, take Google, or really Alphabet Inc., which is a parent company. If you read these voting results, you can see here it says holders of shares of Class A stock vote a single class, but it also says holders of shares of Class B were entitled to 10 votes, whereas holders of Class A are only entitled to 1 vote. So you can see that sometimes the ballots are weighted depending on the type of share, not only by the number of shares, but also by the type of share you own. It's important to not just take the proxy materials as accurate. It's important to do your own research online, understand the issues. If you voted on, some good resources are corpgov.net, As You Sow, ICCR, Glass Lewis, Institutional and Shareholder Services. So it's important to study these issues and then cast your votes. Usually there'll be like a so-called record date, which is like the last date that you can, like the date that you had to have to own the shares in order to be able to vote. So after that date, so after that date, then if you acquire the share, then you won't be able to vote at that meeting. Yeah. Okay. So. In general, the traditional way of voting was to actually physically attend the shareholder meeting and voting there. But nowadays you can vote so-called proxies, which is just like absentee voting. Like you can vote by mail, by phone, or even electronically. Sometimes there'll be contested board elections, like there was at Exxon this year. You'll have 2 different proxy material sets. You'll have a blue set for company nominees and white set for challengers nominees. So let's just take a look at these proxies so you can see, there's like a bunch of information about how to vote and so forth, stuff about all these candidates. If you scroll down all the way down, there is, hold on, okay, scroll all the way down, you can see this is how to vote. So you can go to this website, and there'll be usually there'll be like a certain control number they have to enter in order to be able to vote. You can call this number to vote, or you can just mail this card right here. You can bubble in on this card, mail it to a certain location, a certain address as stated. And then if you take a look at the white proxy materials, it's similar. Let's see. So yeah, you can see right here, this is blank because it's just like a blank version, but in practice when they send these materials out, there'll be a control number that's given right here, and then this is like an ID, and you use this ID to log on to this site and vote, or call this number, or vote this, or send this. This would be printed out, so you'd be able to bubble in right here and then send it. You can do either of those methods. It's also important to note that if you want to abstain, then you need to bubble in the abstain bubble. So let me just show you one more time. Like there's an abstain bubble right here. So if you want to abstain, you need to fill that in. Otherwise, for example, if I wanted to, let's say I want to vote on independent chairman, right? And I want to abstain on that. Then I need to bubble in the abstain button. If I just leave it blank, thinking that I can abstain, instead what's going to happen is whatever the board's recommendation is, my vote will count as that, even if it's just blank. So in this case, the board wanted, or well, in this case, this is a whatever the proxy sender wants, then that will be counted if I leave something blank. So in this case, this was the hedge fund, the engine one. So they wanted a yes vote on, like, say they wanted like a yes vote on independent chairman. Then if I leave this blank, thinking they'll abstain, instead it'll count as a yes vote for independent chairman. So it's important to like avoid that mistake, because you might end up having your votes cast in a way that you don't want if you just leave questions blank. And it's also important to know that you can change your vote. Like you can send as many proxy materials as you want, but only the final ballot cast before the deadline, which varies by company, will be counted. And the official results are usually released in a form like this, which is the Form 8K. In reality, like the Form 8K gets like released it doesn't just get released to announce the vote, but one of these forms, after the meeting will have the vote results. So this is for chevrons. You can see all the results of the various measures that were voted upon. So this is the PDF form that sometimes companies will release, but other cases, for ExxonMobil, you can go to this website, sec.report, and then, Google Exxon, and you'll be able to find it just by clicking on a few links. So this is what it looks like. You can see all various results right here. Okay. Thank you for listening. I hope you enjoyed a lesson on ESG investing.